Hey friends, Lucian here with the Bullish Bears team. This video is going to be about day trading strategies for beginners. Now, there are several different day trading strategies that are out there, but I'm going to talk to you about the three most popular ones, and those are the gap and go strategy, red to green moves, and also shorting. So let's talk about the gap and go strategy first. Gappers are stocks that either gap up or gap down from the previous close. Now you're going to need a good scanner like Trade Ideas to hunt for pre-market volume, because volume is the most important thing with gappers, because it catches up on scanners' radars in the morning. So day traders, what they do is they scan the pre-market each morning for stocks that are running that have volume, because volume equals liquidity, and it also equals people looking at those stocks. So that's what goes on people's watch list each morning on their radar, and that's what they might be potentially looking to trade at open. So again, when you're a day trader, you're hunting for volume, you're hunting for news, stocks that are looking to move, either break out or break down. You put them on your watch list, then you watch at the open and see if the stock's going to run up or if it's going to be a false breakdown and break down. But that's why you kind of weed them down in the pre-market to put them onto your watch list. Here's an example of Trade Ideas pre-market scanner. They're our favorite pre-market scanner. You'll see here, there's a lot of different columns on here. Don't really worry about all these columns. Again, you can tweak Trade Ideas however you like to set up your columns. But if you look right over there, you can see volume today, where it says shares, kind of the, what is it, 6th or 7th column in. You'll see right down there, that's volume in the pre-market. So, you ideally want to see a bunch of volume in there, but it doesn't always mean, just because there's a lot of volume, it doesn't mean it's going to definitely run. It just means that there's a lot of activity going on there in the pre-market. So typically a lot of the ones that have the highest pre-market volume, they're on a lot of the day traders watch lists that open. So typically something's probably going to happen with that stock at the open. It's either going to take off and run, it might drop off a bit, or it could consolidate before either breaking out or breaking down. But this scanner is really awesome. Again, there's other great scanners as well, but Trade Ideas is really kind of in depth, and you can set up so many different columns. Lots of stuff to look for, but again, pay attention to pre-market volume with gappers. It's very important. Here are a few of the things to look for when you're doing gappers or looking to trade the gap and go strategy. So you'd like to see stocks with pre-market volume, ideally around 100,000 shares being traded in the pre-market or more, but it's not required. So ideally you'd like to see at least 100,000, but that's not, a stock could have a few thousand shares traded and then rip at open. But again, the more volume that's happening in the pre-market, the more eyes that are on them, with other traders and other day traders looking to trade them. It goes on their watch list and they're watching those at open. Also, too, you want to make sure that you check for potential news catalysts. So stocks can break out or break down without news. But if you're trading these gappers and you get a news catalyst with it, that helps to make the stock go, either break out or break down. So again, you're a hunter of volatility when you're day trading. So again, if you're a long biased trader, you'd like positive news ideally. If you're a shorter, you like to go bearish on a stock, bad news can create this as well. So if you have a good amount of pre-market volume and then a news catalyst, that's really going to catch more traders' eyes on their watch list at open. So also too, you want to check for daily breakout levels or chart breakouts or breakdowns. So the chart setup is very important. So if you have volume, a news catalyst, and then there's a setup on the chart for a potential breakout, that really brings everything together. So volume, news, and a chart breakout. And it's very important to map out support and resistance levels, map out pre-market highs and lows, and other very important, support and resistance levels on charts again, so you can have the pre-market highs and lows, and then you can map out, your daily, hourly charts, and if it looks like it's going to break out above, a very important resistance level, if you watch and see, at open, if the stock rips and it confirms that breakout and that retest, that might be a good catalyst to show that the stock's going to run. Now, as a day trader, you don't want a ton of stocks on your watch list because it could be very overwhelming looking at too many symbols. So ideally, you'd like to have about 3 to 5 stocks maybe that you're watching at open. So you might filter through, look at, 5 to 10 or so on what's running in the pre-market, and then kind of filter it down on the best setups at open. And then when the market opens, you might have 3 to 5 on your watch list, but really might be zoning in or looking in at 1 to 2 or so at open. Here's an example of what I'm talking about of a breakout. So you can see here's a chart here of SCKT. You'll see right where I highlighted, that was, that yellow area there, that smaller little kind of orange bearish candlestick. You'll see that was kind of a cup pattern that was forming there. And you'll see price had a major gap up on the daily chart. And you'll see, obviously, that thing ripped all the way up to previous high. So when you'll see in many of these, especially these small cap stocks, they rip, and they can rip pretty quickly, especially in the same day. So you want to watch those previous high levels and see as the stock goes up and rips and breaks above. Many times it'll break above and then end up failing. So that's why support and resistance is just very important. So you'll see this one had a major gap up. I'm sure it had a lot of volume on that day. It broke all-time highs, and then if you're bullish on the stock, you want to see if that stock's going to hold those previous high levels. So you'll see this is where you got to be careful with volatility and the pump and dumps. Again, you can do really well trading these, but you have to be aware of support and resistance levels, because if you just buy and hold thinking the stock's going to go to the moon, many times it'll rip, it'll go up, and then end up dumping right back down. Now, how do you trade gappers? Well, what you want to do is you want to look for stocks that will break and hold pre-market highs at open. So when you're mapping out support and resistance levels, look at the pre-market highs and look at the pre-market lows. So if you're bullish on the stock, you want to watch for stocks that are going to go and break those pre-market highs and ideally hold, right? You want to look for things such as bull flags and ascending triangles. Those are a couple of the really more reliable patterns. Again, there's other ones too. There's cup and handles and other patterns, but bull flags and ascending triangles are really popular. And what you want to do is you're either going to look for entries in anticipation of a break of pre-market highs, so you can watch for pullbacks. Look for those little candlestick holds for a potential break of the pre-market high, or you could watch and let the breakout happen, let the retest take place, and then get in on an entry after it holds the pre-market highs. Now here's an example of a stock that broke the pre-market high. So you'll see it had a major gap up. This is DOGZ. So it gapped up. It had a little bit of a pullback. It didn't retest. It didn't go back and retest the pre-market highs. So you'll see it doesn't always go and retest right back to that same spot. Again, that first half hour or so, the market's very volatile. So would you like ideally a pullback right back to the break of pre-market highs? Absolutely. But many of times you're not going to get that. You might just get a tiny little pullback and then the thing just rips and then it ends up selling off after that initial rip. So you'll see right there basically a bull flag. So it kind of breaks out, it pulls back a little bit, not to pre-market high, but you'll see kind of that flag pattern goes up, consolidates back down, and then it rips. So after that, that blue candle, as it's starting to break out of that flag, that's where your entry would be, and then you put your stop loss below that flag. And then you'll see price went up, ripped up those huge big candlesticks, and then as price starts to get near the top and you see those big bearish reversal candlesticks, that's where you would look to exit your position. Here's another example, CTIB here. We'll start off and show you the ascending triangle. So you can see those higher lows being formed, and that's where you can use and create your trend lines, right? So you connect those lower baseline areas, and that creates the trend line, and the trend line extends out to the future. And you can see there is that consolidation where there's like that flat top that was forming. That's an ascending triangle. So you want to see price break out above that ascending triangle and hold. Now, if you're going to get in anticipation of the break of the ascending triangle, that small little blue candlestick that's highlighted there, that's where you would get in on the break above that candlestick, and then you would place a stop loss kind of in the middle of that ascending triangle base. So you would get in right where that blue candlestick is as it's breaking above that smaller candlestick using a stop loss halfway up the ascending triangle. And that's where, if you get in anticipation of the break, you want to see it break out and then hold above that top of the ascending triangle. And you'll see that big orange candlestick 3 minutes later came right back down. It retested and it held, and then it continued up. So that was your entry on the anticipation of the break of the ascending triangle. Now, ideally, when you see a retest, so if you missed the anticipation, when you get a retest, ideally you'd like to see a smaller candlestick retest and hold, like a small little hammer or a tiny little doji. But many a times you won't get that. You'll just get like an orange candlestick like that, just kind of hits and tests, and then it goes and rips and runs. So you ideally like a smaller candlestick risk. This one didn't give you that, and it continued up. You can see those bigger high wave candlesticks kind of flying out there, a little bit overextended. But then you'll see there was a consolidation that pulled back to that lower trend line, and is where you get that kind of that flag pattern, right? That bull flag, that falling wedge pattern, which consolidated back down to the lower trend line. And that's where you would look for your entry on the break above that small little blue hammer. So as it's consolidating and pulling back to that trend line, it gives you some smaller risk on that smaller candle. And as it's breaking out above the hammer, that's where you would look to take the entry on the break above there, and then using the stop loss or so right around below that hammer or so as your stop. Again, your risk is subjective to based upon the pattern and also how big the candlestick pricing is, right? So if right there's not a lot of risk because there's a 5 cent, differential between that 205 to 210 pricing. But if that was 50 or 75 cents, you might not risk all of that, right? So you want to keep your losses small. And remember, you want to have your gains outweigh your losses and have at least a 1 to 2 minimum risk reward ratio. So if you're risking 10 cents, you want to have the ability to make 20, ideally 30 or 40 cents. So here's an example again of an ascending triangle and a bull flag breakout. Some of the things to look for with gappers are volume spikes. So you want to see volume comes in to confirm the breakout. You won't always get it, but ideally you would like to see a lot of volume because there's lots of liquidity there. Liquidity enables you to get in and out of the position a lot more, or a lot easier. So if you have hundreds of thousands, if not millions of volume, it enables you to get in and out of the position. But if you see something break out and it has little volume, it's going to be harder to get in and out of the position. So look for volume spikes. Watch for candlestick reversals and trend line breaks to exit the trade. So as a stock kind of breaks out and it rips, watch for those doji or spinning top or high wave candle reversals. So remember, stocks are like rubber bands. The farther they are away from price action below or the trend lines or the support levels, they're like naturally like rubber bands. They want to snap back down. So as price rips and goes and breaks out, watch for those reversals to come potentially back down. Also, too, if price is riding that trend line or price comes down and retests the trend line and trend lines, price fails a trend line, that might be also a way to potentially look to exit your trade. So trend line breaks, candlesticks, reversals are very important. Now, also, you don't want to get greedy. So when you're day trading, Obviously, you'd love to make tons of money on every trade, right? You'd love to see a penny stock rip and go up and make $1, $2, $3 on every trade, but that's not realistic. That might happen once or twice a month, but typically you're shooting for those 10-cent, 15-cent, 20-cent gains per trade, right? And you're using your account as leverage. So, you're not going to hit home runs on every trade. It's not realistic to do that. Day traders, they're buying their 5,000, 10,000 shares using their account as leverage, and they're looking for the small gains. So again, if you bought 5,000 shares of a $3 stock and you scalped 10 cents, 5,000 shares times 10 cents, that's $500, right? So that's how you make money as a day trader. It's not about going in and buying and, hoping for home runs. And the whole thing again is to keep your losses small so when the trade goes against you, which it will, they're, the best day traders or just traders in general, they still fail 30 to 40% of the time. The reason why they're successful is they keep their losses small and their gains outweigh their losses. The next strategy I want to talk to you about are red to green moves. So what you want when you're looking for with red to green moves is paying attention to the previous close line. So whatever the stock closed at the previous day. So many times the next day, price might break, fall below previous close. It cuts into a previous day's candle before it holds and reverses and goes up. So what you'll want to do is watch for price action to broach previous day's close line. And then you're going to again map out support and resistance levels. Look for bull flags, triangles, cup and handles, etc. And then what you're going to do is kind of with the same process with the gappers. You're either going to look for an entry in anticipation of a break of previous close, or let it go red to green and then wait for the retest. So you can either get in anticipation of the break or let it happen and then come back down and retest and look for your entry. Here's an example of the process. Those orange dotted lines that you see there, or those orange dots, are the previous close line. And you'll see that highlighted blue candle that's broaching previous close. That's the anticipation candle. So you see kind of like across of those moving average lines, and you'll see price close right below previous close there. If you were to get in in anticipation of the break of previous close, you would get in above the break of that smaller blue candle, and you'd use a stop below, put your stop below that candle. But if you miss, so you can get in the anticipation there as it breaks out, and you'll see price comes back down. What did it do? It retested there. It looked like it was going to fail, and then it went and continued up. So that's where there was that bull flag retest. It's not the greatest bull flag. It's kind of bigger candles. You don't always get the smaller candles, but that's where your retest happened, where if you got in on the retest, it would have been the break out of that flag right as it's breaking out of that above that orange candle. So that's not the best, right? Again, if you miss it, it's not always going to give you the cleanest entries. But what you do there on the bull flag retest is get in on the break out of that flag and basically put your stop below that flag. So that's the a couple different ways that you would trade that. Either the breakout of that small candle for the anticipation of red to green, or as it pulled back on that flag, as it's breaking out of that flag, you'd use your entry on the breakout of that flag with a candlestick closed below that as your stop. Next up, I want to talk to you about shorting, right? So shorting gets it's got a lot of misconceptions. Sometimes it gets a bad rap where people say shorting is risky. Again, as I try to teach people, any trading strategy is risky if you don't know what you're doing, right? So shorting is absolutely risky if you're not familiar with what you're doing. But like with shorting, it's the same as any other trading strategy. You have to manage your risk, know what you're doing, map out support and resistance levels, and have a strategy before you enter and exit each trade. So how does shorting work? It's the opposite of going long or being bullish on a stock. So you're, instead of with going long, you're going to buy low and sell high, right? So if you're bullish on a stock, you want to buy low at support levels, sell high near resistance levels. With shorting, it's the opposite. You're going to sell high near resistance levels and then buy low to cover. So when you're selling high, it creates a negative position. So if you were buying and going long on a stock, you bought 1,000 shares, you would see plus 1,000 shares in your brokerage account. When you're shorting, again, this is not scary. A lot of people, it takes a little bit of time for a lot of people to grasp this concept, but it's all done automatically with your broker. It's simple to do. So when you're shorting, you're hitting the sell button to start, not the buy button. When you hit the sell button and you sell 1,000 shares, your brokerage account will show negative 1,000 shares, right? Or however many shares you buy. When you buy it back, when price falls, you're covering your position, and then your position's evened out. It's as simple as, it's just the complete opposite of going long. It just, instead of showing positive 1,000 shares, it shows negative 1,000 shares. So you're selling high near resistance levels, and as price falls, you're covering or buying that position back. You even out your position and you keep the difference, right? So let's say you sold a stock at $2 and it falls to $1.50. You made 50 cents on the position. Now, the thing that's important to remember with shorting or to be aware of is you need to be able to have shares from your broker. You need to be able to borrow them. And to do that, it's not as simple as just, any broker. You can pretty much buy shares with any broker. But when you're shorting, you have to have a broker that is good for locating shorting shares to short. And not all brokers are good for shorting. The best brokers, or a few of the best ones for locates for shorting, are Speed Trader, Interactive Brokers, and Centerpoint. Interactive Brokers is a little bit more of an economical broker. Speed Trader and Centerpoint usually get you the best locates. You have to put more, depending on when you're watching this video. You have to put a decent amount of money, at least 25,000 or more, into a Speed Trader account or a Centerpoint account to get set up. But again, depending when you're watching this video, they might change their account minimum. So just reach out to them just to see. Interactive Brokers, you don't have to put as much money into an account to get set up. But all three brokers are really decent at finding shares to locate for shorting. Let's do a shorting example. Again, repetition is the key when understanding and practicing and learning all the different concepts of trading. So let's use an example, XYZ company. Let's say you sell 1,000 shares of XYZ company at $3. That's a total of $3,000. So you now have a negative position of $3,000 in your brokerage account. It's not scary. It's scary if you don't know what you're doing, right? But it's scary to, right? It's scary to hold 1,000 shares of a company if you don't know where you're buying, right? So anything where you're buying or selling can be very scary if you don't know the process. It's not scary to hold a negative position if you have a plan and you know how to do it, right? So now, again, in this example, you're negative 1,000 shares, or $3,000. So you sold at $3 at resistance levels. Now let's say the price or the stock falls down to $2.50. You're going to sell high and then buy low to cover. So covering your position means you're just buying it back. So you went from a negative position to a positive position, and it evens out. So you're not, I'm going to rephrase that. You go from negative to evened out. You're not going to own shares. It's just selling it. You were negative 1,000. When you buy it back, now you're back at zero. Your position is even. And so how this works is you would keep the difference of 1,000 shares times $3, which is $3,000, minus 1,000 shares times $2.50. So that is a profit of $500. You sold at $3 and you bought back at $2.50. So you sold high, bought low. The reverse of that example would be going long. You would buy at $2.50 and then sell at $3. and make the 50 cents and 500 bucks, right? So this is all done automatically with a broker. It's simple. So just don't worry about it if you're new to it. This is where we always suggest paper trading, depending on what broker you go with. Practice shorting a few dozen or 100 times in an account, and then you'd be like, oh, this is simple to do. At first, like any type of concept, it could be intimidating or scary, but that's where you practice. So even going long on a stock, if you're brand new, practice paper trading. When shorting, practice paper trading. If you're doing options trading, practice paper trading. You can't lose money paper trading, right? Here's an example of shorting. So you can see I put a couple lines up there, those dotted lines. You'll see price kind of moved up, and you'll see it kind of got further away from those moving average lines. So it's a bit overextended. And you'll see that orange candle couldn't break that previous blue candle's high. So you'll see there's two equal tops up there. That's called tweezer tops. We teach you how to trade candlesticks. Again, very important to understand how to trade candlesticks. We have our free ebook in our candlestick or our courses section. Make sure you download it and learn candlesticks. But that pattern right there is a tweezer top pattern, which shows a potential reversal coming. So what happens on those tweezer tops is you would typically take a short position as price falls below that second candlestick, that smaller orange candlestick. So you would short as price fails and falls below that base, and then use a candlestick close above the top of those candlesticks together, the two equal tops, as your stop. So you can see that candle as it's falling there. It created a kind of a high wave candle there, but you'll see it kind of went back and retested the top, but there was no candlestick close above it. And then you'll see price started to fall. And as it's falling, it's kind of creating that falling flag or wedge pattern, that down channel. So you can create those bases and then watch as the lower highs are being formed, as it's breaking, finding that base there, you'll see as it's starting to break out of that falling channel, that's where you would look to potentially cover your position. Again, this is all based upon how much you want. Everybody's risk tolerance is different. Some people might stay in it longer as it continues to fall throughout the day. But if you're selling right there, if you took that position and you sold the break below that, just call that $5.10 area, as you're taking a short there. If you took it, around 510, let's say your entry, and you covered right around that 485 level, you would keep the difference between 510 to 485, right? So what is that? That's about 25-cent difference. So if you shorted 1,000 shares and you would have made 25 cents, so 1,000 times 25 cents, that's about a $250 profit. And that's how shorting works. You sold high and then you bought low to cover. Now, again, there are a lot of different day trading strategies that are out there. A great place to learn is our trading community. So if you are new to the world of day trading, or even you've been doing it for a while and you want a good community to learn from, we have lots of great teaching and mentoring every day in our trade rooms. Our mods, our community members are very helpful. We are not a pump and dump community, so we're not going out there and pumping stocks to our members. We're teaching our members. We're doing real-time coaching and mentoring and training in our rooms. So if you're new or you want to learn more, come into our trade room, ask questions, interact with other members, and then practice implementing what we teach you. So the best way to do that is in a paper trading account. So you can come in, learn, practice trading our watch lists and our trade alerts in a virtual account, make a couple hundred trades, get familiar and comfortable with what you're doing. And then as you get comfortable, with paper trading and you've tracked your trades, right? So track your trades, look for that 60 to 70% win-loss ratio. And make sure your gains are outweighing your losses after you made a few hundred paper trades. Then slowly scale your way up trading with real money. And again, scale your way up. So if you're going to trade typically with, let's say, 1,000 shares of real money at a time, start off with 100 shares and maybe do 250 to 500 to 750, and then you'll eventually get up to your typical amount of shares that you would trade of, let's say, 1,000 shares. But treat your paper trading account exactly like you would a real account. So hopefully this video on the basic day trading strategies helps you, and we will see you in our community. Enjoy.